Hello, MBA 503 students. This is the last in the um, this is the last video in the series of 3 videos that serve as an introduction to the course, basically. Now, this video is going to be kind of like, this is Professor Hazara, obviously, again. This video is going to be kind of like the second video, but with more detail. We're actually going to do a textbook example of how to write up financial statements. It's still very basic, but we got to start practicing how to write up financial statements. And after we learn how to write up financial statements, then I'm going to actually get into we are actually going to get into a bit of financial statement analysis, because for MBA students, it's very important to know what you're reading and how to prepare financial statements at a basic level. But once you have the fundamentals down, it's very important to be able to analyze the financial statements. So anyway, let's go ahead and start. Let's see here. Let's start with the PowerPoint, and I'll put the slideshow up from the beginning. Okay, so there's 2 purposes to this video. The first one, we're just going to review some of the details of financial statements. I already talked about a lot of these things in the second video, but these are to review and lead up to the second objective of this video, and that's financial statement write-up. So I'm going to very quickly review the details of financial statements and some accounts. We call them elements of financial statements, actually, and then we'll do the financial statement write-up. An example that I'm going to do on an Excel worksheet, and then send you the worksheet. So if you didn't follow everything, you can either repeat the video, or you could actually look at the Excel worksheet that I make in this video and then send to you as part of an email. Okay, so anyway, let's go ahead and start. Okay, so here's what you got. Elements of financial statements. Okay, and I'm just going to review the financial statements. First of all, the balance sheet. Now, keep in mind, the balance sheet equation, I'm just doing this to remind you, is assets, that should be a plural, by the way. Assets is equal to liabilities plus owner's equity. That means that a corporation's resources is equal to what they owe and what they owe and what the shareholders own. The claims of outsiders, the liabilities, claims of insiders, that's shareholders. Okay. Now assets. Now I'm going to review some of the assets because we're going to use those in the Excel example that I put in the final part of this video. Okay, so current assets are converted or consumed within 1 year. They're converted to cash or consumed within 1 year. Okay, and let's get some examples. Cash, obviously, cash, we call them cash and cash equivalents, but it's cash. Everybody knows what cash is. Second part, accounts receivable, money owed to this company, in this case, if you were Pfizer, money owed to Pfizer, excuse me, in the short term, okay, within 1 year. So these are amounts that will be paid by customers or other people within 1 year to the company, or companies or customers, people or customers. Okay, and I put the word receivable in red to remind you that any account with the word receivable is generally a current asset, and it's money, definitely, that you're to receive. It's owed to you. Okay, you being the company that's doing the accounting. Okay, inventory, very important asset. It's generally speaking, it's goods held for sale by customers. So if Pfizer makes a drug and it gets approval and all that stuff, and there should be an inventory for those drugs. Now, there's been a lot of offshoring in the recent years, so that would mean that the company actually in the supply chain, maybe it's in China or maybe it's in India, wherever, I don't know. All the drugs may be coming in, maybe actually made in another country, in a factory in another country. And that actually, as you will learn in your next accounting course, that actually would reduce the inventory on a company's books. But that's time for another course. Okay, marketable securities. These are securities intend to be sold on the market. Okay, let's go on here. Prepaid expenses. Prepaid expenses are services owed to the company since the services were prepaid. And this makes sense. If you prepay your rent, if you prepay your insurance policy, which usually happens, if you prepay legal fees, like you get a lawyer on retainer, okay, that means that they owe you service. and that's what is a prepaid expense. They're current assets. We're going to learn that prepaid expenses over time are written down. As the service is performed, the prepaid expense account is written down. Okay, let's see the next one. Okay, non-current assets, assets with lives greater than 1 year. And this is very important, I think, for your company. Property, that's pretty obvious. Plant, that's pretty obvious. Equipment, that's pretty obvious. Okay, intangibles. Now, intangibles, such as patents and copyrights, are assets. And so companies which engage in high levels of R&D, like Pfizer, will have, as the R&D is developed into a product that can be sold, then it becomes, and maybe you have a patent that comes in, and a lot of the value of the R&D ultimately comes from a patent. Okay, long-term investments of any. These are long-term investments of any kind that the company expects to hold for more than a year. Okay, so the difference between short-term investments and long-term investments is short-term investments are investments the company intends to sell within a year. Long-term investments can hold on to them for more than a year. Okay, liabilities. Now let's get to current liabilities. Amounts owed within a year. Basically, that's the idea. Okay, in a sense. Accounts payable. Now, I'd like to put that word payable in red to emphasize that it's the opposite of receivable. Accounts payable are amounts that you owe somebody within the year. So any receivable, money is owed to you and it's an asset. Any payable, you owe money and it's a liability. Generally current liability. Accrued liabilities. These are other types or other short-term payables, such as rent payable, salaries payable, utilities payable. You just take any service you receive and put it in front of the word payable, and it's an accrued liability. Okay, it could be, it's anything you wish. Okay, now unearned revenue, I think I talked about this, but this is the opposite of prepaid expense. This is when you receive cash in advance for a service you owe somebody else. So if you're a law firm and you are given $10,000 of cash for services to be paid over the next, to be provided over the next year, then you owe those services. And that's called unearned revenue. The reason is somebody gives you $10,000, but you can't record the revenue until you actually provide the service. So, and that's a rule we're going to get into very quickly in a couple chapters on when you recognize revenue, basically. But basically, the idea is if somebody gives you something up front, they expect a service in return. So until you provide the service, it's unearned. Non-current liabilities, amounts owed beyond 1 year. Okay, now these are, let's my notes here. These are examples of bonds payable. This is the ultimate non-current liability. Bonds can, companies issue bonds and stocks to long-term, to engage in long-term financing of the business. So bonds payable. That's one of the big ways of obtaining capital. Mortgages, obviously. Most mortgages go on for 30 years. Any other long-term payable. Okay, so you could owe the government money over the next, beyond the current year. That would be that'd be long-term taxes payable. Some companies issue long-term notes, which are just like bonds, but not marketable. They don't have, there's no exchange for their bond, or notes. That would be long-term payable. Okay, so next here is shareholders equity. Okay, now this is kind of important. It's not hard. Shareholders equity is probably the easiest part of this course. I think it's chapter 9 or something like that. But shareholders equity is probably the easiest part of this course, as you will see. But it is important to recognize that shareholders equity has two components to it. The first one is paid-in capital. Okay, I put contributed capital, but you also call it, it's the same thing. Some people call it contributed capital, and I use both names, obviously, and some people call it paid-in capital. Okay, this includes any amounts obtained by issuing common or preferred stock. Now, paid-in capital, there's two categories. Okay, there's an account, a line item, for the common or preferred stock that was sold. Now, this usually only reflects the par value of the stock. And as you'll find out, par value is kind of a meaningless value placed on a stock when it's sold. It has nothing to do with market value. It's just a legal value that's placed on the stock. You may ask why. Well, it's an old concept. Goes back many years. And it had to do with not being able to pay or limiting the amount of dividends a company could pay on the stock. Okay, and the second one, it's almost exactly the same account as common stock, because when you issue stock, if you have a low par value, both of these will go up. But this is called additional paid-in capital. This includes any amount received beyond the par value of the stock. So if you issue one share with a $1 par value and sell it for $10, that means that the $1 goes into common stock, and the difference, the 10 minus 9, goes into the additional paid-in capital account. Okay, so that's the first big category of financial statements. Okay, now here is an incredibly important account. I would say if you look at any set of financial statements, this is probably the second or third most important account. Okay, and is retained earnings, because this is retained earnings is the account which kind of brings all the financial statements together. You may remember from my example on articulation of financial statements, there was a statement of retained earnings. That means to me that if a statement of retained earnings, or which calculates retained earnings, brings together the balance sheet and income statement, that must be a very important account. Okay, so these are the cumulative earnings, net income, or when we talk about earnings, we're talking about net income. They're available to company for the company to pay dividends. I put 2 for these in there. Okay, but anyway, so what happens is if you have accumulated $100,000 of retained earnings, you cannot pay more than $100,000 in dividends. Generally speaking, that's true. Some companies, there's no legal provision, at least in Rhode Island, but some companies I've seen that they pay so many dividends, they actually go into negative retained earnings. That's possible. Generally not seen as very sound financial practices. Okay, and now this is the income statement. Okay, now the income statement is revenues minus expenses equal net income. And I'm just going to go over 4 items here on the income statement because we're very fast going to get to our example of a financial statement right up here. Okay, so the income statement is revenues minus expenses. But let's go get a little more into detail. Okay, revenue increases in resources resulting from your operations, and this is very important. This results from your operations, from selling the company's goods, and in the case of Pfizer, it would be drugs, I guess, and or services. If you provide a service, that's revenue also. Gains. Now, I want you to distinguish between revenue and gains. Revenue is from operating your business. So from selling what you sell or providing the service that you provide. Gains are a little bit different in that they're like revenue. They result in an increase in assets in the wealth of your company. However, gains are something that occur less frequently, and they're generally non-operating. Revenue is from operations. Gains are generally not from operations, and gains usually result from selling an asset. And there's other places we can get again, but most of them result when you sell an asset at a price greater than the asset's cost. And there I give you an example. A company sells a piece of equipment that costs $10,000 for $15,000. You'd have a $5,000 gain, and that has the same impact on our net income as revenue, but revenue is from operations. Okay. Expenses. Okay, so now we got the minus expenses. Okay, decreases in resources resulting from operations. So expenses are the exact same as revenue. You're in operations, you have to pay people, you have an accounting department, you have a marketing department, you have advertising, and all those things are expenses. But the result, you're paying out, so that means that you're decreasing your resources, usually cash or ultimately cash. Okay, cost of goods sold. Now, I do want to emphasize an expense that I'm going to get to in the video or the Excel example in a second, but cost of goods sold is a key expense, and it's the cost of the goods that you sold this period. So if you sell, let's say, one baseball bat for $50 and it costs you $30 to make, your revenue from those transactions would be, your revenue would be $50, but your cost of goods sold would be $30. So we'll get to this in a second, but your gross profit on the bat would be $20. Okay, so it is the cost of the inventory that's sold. What companies always do, as you'll see in a second, is they match it against the revenue, and they take the revenue less the cost of goods sold, and that's their gross profit by definition. Okay, now losses. Okay, losses are exactly the opposite of gains. This usually happens if they're non-operating, generally speaking, and this happens when a company sells assets for a price less than the assets cost. So if a company sells a piece of equipment that costs $10,000 for $12,000, they would have, that should be $2,000 loss. I don't know, I changed examples, but obviously that would be a $2,000 loss, not $3,000 loss. Okay, having gone through that, now let's go to an Excel example, and I'm going to escape from here in a second. I'm going to put up an Excel worksheet, okay, and that Excel worksheet looks like this. And I will send you, after I finish this worksheet doing it on the video here, I'll actually send it to you as part of an email. So you can go back over the video, or you can also look at the worksheet that I've built here in order to study the problem too. Okay, so here you've got a bunch of accounts here. So here you've got a bunch of accounts, okay? And what I'm going to do is I just want to go and at least go through, list them down here, create a list here, and I want to just think about where these go. Prepaid insurance, that's a prepaid expense. So that would go on the balance sheet. I'll use BS for balance sheet. What an acronym, huh? BS. Anyway, so I'll go through balance sheet. I would say that's a current asset. Prepaid expenses generally are current assets. Okay, out here. Okay, so this is just, I want to go through and just indicate where they belong, and then we'll build some financial statements. Our equipment, that obviously goes on the balance sheet, and that's a non-current asset. Why is it a non-current asset? Because it goes for much more than a year. Cost of goods sold, that goes on the income statement, and it is, I'll use IS, is, I never thought about it. IS, and that is a current, that is a, that's an expense. I'll just say expense. I should report operating expense, but we'll label one when I make the statements. Okay, that's an expense, obviously. Salary expense, well, let's correct this, and I just copy it down. Salaries expense, that goes in the income statement, it's an expense. Okay, now we get to something called, and this is the first time I even mentioned this, something called accumulated depreciation. Now, it goes on the balance sheet. Now, this accumulated depreciation is something that you're going to deduct from the book value of your long-term assets, and you'll see what I do with it. But basically, it's that if you buy an asset, the depreciation accumulates over time. So we're going to take the cost of the asset, record the accumulated depreciation as the years go by, and that's we're going to deduct that from the balance sheet. And I'm going to say this is a balance sheet non-current asset. Okay, but I'm going to put in here, because I'm just calling it non-current asset because it is a deduction from equipment, probably in this case. Okay, but what I'm going to put here is, we call this a contra account. Okay, and I want to make sure to get that right. That is correct. We call this a contra account. Now, for those of you who might speak Spanish, yeah, it's if contra, it means kind of like against in Spanish, and that's where the word comes from. It's something that we deduct against a long-term asset account. You'll see what I do with it when I get down to the balance sheet. Okay, accounts payable, that's a balance sheet. That's a current liability. Okay, cash, that's obviously from the balance sheet. That is a current asset. Same thing for accounts receivable. Accounts payable is your ultimate, or salaries payable. That's a current liability, no question, because those are usually because your pay period doesn't coincide with your end of year financial reporting. So salaries payable is a current liability. Common stock is balance sheet. I'm going to say it's shareholders equity, and it is PIC, paid in capital. Remember, there's two categories of shareholders equity: paid in capital and retained earnings. Okay, depreciation expense, that's an expense from the income statement, and that's just depreciation for the current year. Think about this: depreciation expense is depreciation for the current year, whereas accumulated depreciation is the total depreciation recorded on the asset since you bought the asset. So one is accumulated, and that's at a point in time how much you have total, how much total depreciation you've deducted from an asset. The expense is the depreciation expense over a period of time, generally 1 year, let's say. Okay, beginning retained earnings. Retained earnings are a balance sheet account with one little correction here. Balance sheet account, I'm going to take off. It's just shareholders' equity. That's one of the major categories of shareholders' equity. Dividends. My God, what are dividends? Dividends, some people think it's an expense. Dividends is not an expense. But if you recall, in my example, I think in the last, on the articulation of financial statements, dividends are deducted from retained earnings. And keep in mind, you can do two things with retained earnings: pay dividends or retain it for reinvestment. So dividends really is, I'm going to say it's really part of the balance sheet. It's part of the calculation, part of the calculation of retained earnings. Keep in mind I'll go through this, but you deduct, dividends are a distribution of income or earnings, as we would call them, and it comes out of the earnings that you've retained. You've chosen not to retain them, so you pay them out as dividends. Okay, service revenue, that's obviously income statement. I'll just copy this down just to make it easy on myself. But it's obviously not a income statement. It's revenue. And I got to change one thing in this example. Here I have service revenue, but service companies do not have cost of goods sold because they don't sell goods. So what I'm going to do here is I'm going to change this to sales revenue. And change this to sales revenue. Okay, and then the last three things are all expenses. So we can just copy those things down here. We're going to have repair expense, insurance expense, and tax expense. These are all operating expenses. Obviously, repair sounds like an operating expense. Insurance, you probably need to buy insurance to stay in business. Taxes is not considered an operating expense. You'll see what we do with it at the bottom. Okay, and so that takes care of that. Now I'm going to go ahead and I'm going to erase these financial statements. They were built for a service company originally. So I'm going to take out the financial statements, and I'm going to go ahead and delete some rows here. Sort of start from the okay, and the first thing I'm going to do is I'm going to go ahead and merge three rows of cells. I'll do that. I know this looks tedious. Maybe it is a little bit, but you're going to have to work in this class. You're going to have to work in Excel, and not all. And I've discovered that not all people are familiar with it. Okay, so anyway, so the first thing I'm going to do is I'm going to put it right in these three spaces. I'm going to write balance sheet. So I'm going to write and let's pretend that the balance sheet is as of balance sheet. And what should I call this company? I'll just call it the ACE uh, department store. And I'm not going to be too fancy about it, but let's say this is the balance sheet as of 12/31/19. Okay. And so I'm just doing this to emphasize you have to title this thing, and it's as of a specific date. Now I'm going to cheat a little bit, and I'm not going to give any assets or liabilities for this balance sheet. Take out a row here, clean this up. Okay, so I'm just going to say assets, and I'm just going to leave this blank. So I'll just leave the assets blank. And why I'm doing this is because if I had a beginning balance sheet, this would be too hard for you at this level. So I'm going to leave the liabilities blank also. Okay. So we'll do this. Okay. And shareholders equity. You have common stock. So for shareholders equity, you're going to have paid in capital. And I'm going to leave that blank too. I'm going to leave that blank too. And the only part of this balance sheet which I'm not going to leave blank are your retained earnings. Now these would be the retained earnings as of 12/31/19. So those would be from a 2020 perspective, because we're going to make 2020 financial statements. These would be your beginning retained earnings. And I don't want to put in all the details of this. We'll do it later, but I want to just pretend that the retained earnings for this company, it says beginning, are 14,000. So what I'm doing is just making sort of a balance sheet and saying, well, we'll assume the assets and liabilities and shareholders' equity and paid in capital are all correct, and I don't even have to know them, as long as you know that the retained earnings, beginning retained earnings, comes from the balance sheet. I'm trying to emphasize that. The example would take a long time and be much more complex, and we'll get to doing something like that if I put in all the beginning assets, liabilities, and shareholders' equity. Okay, so when you're working in a year, that's your starting point, basically. Your beginning retained earnings. You know all these things, but your beginning retained earnings is where you start. Okay, the next part of this, and maybe I can just, very handy here, I'll just delete those rows, and we'll say that this here is going to be, I'll just, income statement. And the income statement is going to be for the ACE department store. And it's going to be for the year ended 2020. And notice that this income statement is for a period of time, beginning January 1st, 2020, ending December 31st, 2020. Okay, so now let's put those in there. And now what I'm going to do is I'm going to start taking amounts from the list of accounts that I have here, and we know that the financial statements where they go, and I'm just going to start filling in the income statement here. So the first line, keep in mind that the equation for the income statement, in very rough terms, is equal to equation is revenues minus expenses. Okay, so basically we start with the revenue. We're going to take out expenses. We're going to have two or three subtotals though. Okay, but basically it's revenues minus expenses. Okay, so let's see what we got here. Let's start with sales revenue. Okay, so start the income with sales revenue. And I'll move out a couple of columns here. And my sales revenue is equal to 58,000. Okay, and I could almost just, as I go through these things, I'm going to check them off. Okay, so you just use them up once. So there's your sales revenue. It's 58,000. Now here is what any big company should do, and most of them do. I recently saw one that didn't on their income statement, but it's no big deal. I wonder which company that is. Okay, but from sales revenue, you always take out. I'm going to put here. You're going to take out, and I'm just going to say, I'll write it in. You take it out your cost. Take out cost of goods sold. Okay, and the reason for that is, like I said, just mentioned, is that revenue is a plus number. Companies tend to match their sales revenue, which is what the revenue they made on selling the products, against the cost of goods sold, which theoretically should be the cost of those same exact products. Okay, let's see. So I'm going to put that as a negative. Okay, so my cost of goods sold up here is 36,000. I'm going to go ahead up here and put an X by this as I use them up. Okay, so what companies do is they take their sales revenue, deduct their cost of goods sold, and that gives them gross profit. And most companies that either are in retail or manufacturing of some sort use a subtotal, which is called gross profit. And this gross profit is incredibly important. It's basically your first line of profit. If you don't have a gross profit, which is just what you make on the basic sale of products, the revenue you got minus the cost it took you to buy them from a vendor or to make them if you're a manufacturer, you don't have gross profit, you have a non-viable business. Okay, so we do that. And gross profit, notice that I put a negative in there, but if you want to see the equation right there, there's the equation right there. And it's a negative, so I added the two numbers together. And basically, it's the 58,000 minus 36 cost of goods sold. 58,000 revenue minus cost of goods sold of 36 gives you a gross profit of 22, excuse me. Okay, then I'm going to take out, I'm going to call these operating expenses. So we'll call these operating expenses. And these are usually fairly easy because they're just one-time line items. Okay, so let's take out your operating expenses. Now I see, looking at this thing, there are 4 operating expenses here. Okay, and these are all going to be negative. So I'm going to take out, let's put the titles in first. First thing I'm going to do is take out salaries expense. Okay, and I'm going to put a negative. Let's see if I can. Nope. It's supposed to be a value. So we'll just go back to salaries expense. But these are all deducted. Okay, then I'm going to take out depreciation expense. These are all expenses that you incur while operating a business. So I'm taking out depreciation expense. Then I'm going to take out repair expense somewhere here. Okay, and then finally I'm going to take out insurance expense. Okay, and These are all going to be negatives. I think I have to take out some rows here, and I'll be back to this. So let's take out these rows here. Okay, so I'm going to go ahead and take out these rows. This is generally, delete entire row. Okay, so we got insurance expense here. So this is going to be your. So I got depreciation expense. I got to put in a row now. I don't know what happened there. Insert entire row. Okay, and so this first one was salaries expense. And I know it seems silly doing this, but this is the sort of issues you run into. So excuse me, that is the amount. Salaries expense. That was there. And then finally, your final one was insurance expense. Down here. Okay, now these are all negatives. So these are all going to be deducted. I don't know what happened there. Maybe I didn't go away. Sorry about this, but this is what it usually takes. Okay, so I got my insurance expense. Okay, I got my insurance expense there. That's what I want. Okay, now what I'm going to do is I'm going to put them a column to the left, and then I'll subtotal them and put the subtotal in the right in the column to the right. Okay, so your salaries expense is going to be equal to a negative, whatever salaries expense is. That is going to be equal to a negative 2,100. Depreciation expense is going to be equal to a negative. Let's see what I have for depreciation expense here. 5,700. Your repair expense is going to be equal to a negative. I should put negative here. Negative 2,500. And that's your repair expense, and your insurance expense is going to be equal to a negative 1,200. Okay, so those are all your operating expenses, and I'm just going to put this in bold because it is a subsection, subtotal. Okay, so I'm going to put here total operating expenses. Okay, so the total operating expenses is gonna be equal to, and I'm going to sum it. There's only four of them, so you can see where I'm sorry. I'm sorry, it's the sum of these four. I could use the sum function. Okay, so your total operating expenses are 11,500. Now notice what I've done. I've taken my gross profit, which is a plus number. It's a plus number. You see it right there. And then I've taken. I'm going to put an underline here. I've totaled all my operating expenses, so I'm close to finishing the income statement. I'm going to go ahead and put an N here. Okay, so I'm going to call this earnings before, or I'm going to call it income. Let's call it income. Income before taxes. Okay, and this is important for financial analysis because analysts want to know, if you're looking at a set of financial statements, what you want to know is how much did the company make from its operations? Tax expense, and more importantly, interest expense are not part of operations. Interest expense is determined by how much debt you have, not by how you operate the assets that you finance through that debt. Okay, so there are types of expenses which are functions not of operations, but of your tax bill, the talent of your accountants and lawyers, and the level of debt you have. So I'm going to just do this. Basically, I'm going to subtotal these two. Plus, that's a minus. So your income before taxes, some people would call this operating income. Your income before taxes is 10,500. Now I'm going to take out my tax expense, and a lot of people in accounting call it the provision for income taxes, but I'm just going to call it tax expense here, and that's going to be equal to a negative 2,000. It looks like a negative 2,000 is my tax expense. Okay, so that gives me my tax expense. I'll go back and check them off in a second. Anyway, so my net income here, my net income here is going to be the income before taxes plus the negative. So my final net income is 8,500. So there's my income statement. This gross profit step is very important. I'll be very honest. The company that I saw that didn't use this step, and you'll see it when we go over the financials, is Pfizer. But you know, it's neither here nor there. Not criticizing, generally speaking. There's a lot of companies that do a lot worse things. Okay, so let's go ahead. I'm going to X off all these accounts that I've used up. I've used up any expense. I'm going to say that one. Depreciation expense. I've definitely I've used up beginning retained earnings. Again, beginning retained earnings. I've used that one up. Okay, I've not used dividends again, but I've used up these three expenses, and I've used up cost of goods sold. So I got one. Looks like I got most of the ones I've used up. Okay, so now I've made my income statement. And as you recall from articulation, the slide on articulation, after the income statement comes your statement of retained earnings. And the statement of retained earnings is going to be what brings everything together. Okay, so I'm going to go ahead and merge these cells now. And I'm going to be very careful about this. And it seems tedious. This is the sort of work that I'm asking you to do in class using Excel worksheets. Okay, in accounting class, without using at least some Excel worksheets and real life examples, wouldn't give you a lot of training, let's say. Okay, so let's say statement of RE retained earnings. Actually, the company name should come first, but it doesn't matter. So let's see what our company name is. Ace Department Store, and this is statement of retained earnings. I'm going to say, well, it should be for year ended 2020. In a sense, retained earnings are both kind of mixes the income statement, which is a period of time, with the balance sheet, which is a point in time. Okay, so let's see. Really more of a balance sheet account retained earnings, although it includes net income. Okay, so I'm going to go ahead and type in. I'm going to type in my beginning retained earnings. I'm just going to put that there. I'm going to put beginning retained earnings is. I'm just going to just make it equal to this name right here. Those are my beginning retained earnings. Okay. It's equal to, now I want to emphasize this. You draw your beginning retained earnings from last year's ending retained earnings. So you have to go back to your balance sheet. That's why I put this little fake balance sheet up here, just to emphasize that you have to go back to your 12/31 2019 retained earnings, which are the ending retained earnings for 2019, but the beginning retained earnings for 2020, and that's what your beginning retained earnings would be equal to. Okay, to that, I'm going to add my net income. So we're going to take that net income, and this is part of financial statement articulation. First of all, your beginning retained earnings come from your last year's ending balance sheet, 1 year's ending balances, the next year's beginning balances, and your net income for the year comes from your net income statement. Okay, and I'm just going to go ahead, underline that, and that's going to give me, I'm just going to call it subtotal. But you could call this retained earnings before distributing your dividends. Okay, so you had net income, beginning retained earnings, plus a net income of 8,500 means that you can distribute up to 22,500 in dividends. Okay, and let's see what our dividends are. Our dividends, make sure dividends do not go on the income statement, they go on the statement of retained earnings. Boy, do people getting bad habits there. So dividends are paid out of your income, your accumulated income of 22,500. So this is going to be equal to a negative amount for dividends. So I'm going to say negative that amount. That's your dividends right there. Okay, so this is going to be your retained earnings. But I'm just going to change this to ending. Okay, and so your ending retained earnings be a subtotal. going to be the 22,005 plus a negative. It's really minus. So your ending retained earnings are 14,900. Now we're going to go ahead and finish up his balance sheet. Not a very complex balance sheet, but it's good. It's a good lesson here. Okay, so I'm just going to go ahead and align these things. I forgot the keystrokes for repeating an action, so I'm just going to go ahead and do this here. Okay, so you have alignment. Okay, I'm going to merge cells. I'm going to merge these cells too. And then we can go on to our balance sheet. Okay. Okay, so let's put a, this is balance sheet. Really, the company's name should go first, but at this point, it's all good. Balance sheet. This is for the ACE apartment company at 12/31/2020. This is definitely balance sheet. It's notice that this is as a specific point in time. This is for as a specific point in time. Okay, so let's go ahead and go down and see what categories we have here. Now, the first thing you're going to have is you're going to have your first item on any balance sheet is assets. And we'll have current assets. We have certain current assets. And then we have, and then we'll have long-term assets. We'll worry about those in a second. Or non-current assets that I'm calling now. Okay, and you can have, these are both just titles. Okay, and let's go ahead and take our current assets. We have, as far as I can see, we have 3 current assets. We have cash. So let's go ahead. I'm just going to go ahead and write the name in there. Cash. Then the next one is we have accounts receivable. And I see a slight error in this problem. I should have inventory. Well, I will put some inventory there. Anyway, let's put up accounts receivable. That's perfectly fine. So let's find accounts receivable in this list here. There's your accounts receivable. And here's what I'm going to do. I'm going to, instead of having prepaid expenses, I need an inventory. Because this, if you have cost of goods sold, you need inventory. So I'm going to just, what I'm going to do is type in, or I know what I'm going to do. I'm going to change, you're going to get the same effect. It'll balance in the end. But I'm going to take the prepaid insurance account, and I'm just going to change that to the name to inventory. It probably would be a very realistic level of inventory, but there's just-in-time. So as just-in-time inventory managers come in, inventory gets smaller. Okay, so I'm going to put inventory on here, and the reason I'm doing this is because when you have cost of goods sold, it means you're making a product. You're a retailer manufacturer, and retailers and manufacturers have to have inventory. Okay, so here's what I'm going to do. I'm going to put up, I'm just going to leave it at one column here, and I'm going to put up the current assets. So your first current asset is cash. These are all positive numbers because they're resources. Your first current asset is cash. Your second current asset is accounts receivable. It's 7,500. And your inventory, which was prepaid insurance, now I changed that. I adapted this example from a service company. That's why. Okay. So I'm going to call this total current assets. And I'm just going to subtotal this. So your total current assets are going to be equal to your cash plus your accounts receivable plus your inventory. So that's your total current assets. Now I'm going to have, and I can actually move it out here. It's not a big deal, but that'll make my addition easier. Okay, so there's your current assets. Now I'm going to put in non-current assets, and there's only basically one non-current asset. Okay, and so the non-current asset is going to be the equipment equipment has at least a 5-year life, so your equipment. However, here's what you got to do. Now, I'm going to write this in because it's so important. You subtract from any category of, or any major category of non-current asset, your accumulated depreciation. Okay, and that's why it's called a contra account. So we're saying that your equipment has a value of, let's see, go up here. Your equipment has a value of $31,000. That's how much you paid for it. But against that, over the years, you have accumulated depreciation, and I'm using both this term as a noun and an adjective in a sense. You accumulate depreciation of $8,600. Now, what does all this imply? First of all, I'm going to tell you the term, but I'm going to give you an implication of this. So we're going to call this net book value. Now, in accounting, always look at the meaning of the words. This is saying that you paid $31,000 for this equipment. You've accumulated a total of $8,600 in depreciation over the years. Okay, so I'm just going to go ahead and sum these two. And the term net book value, that means that your remaining value, the net book value, equipment-wise accumulated depreciation, but we call it net book value. It's basically the value that you have, the productive value of your remaining equipment. Now, it's book value, so it's not market value. Market value might be very different. But what we're saying here is that you've depreciated, you've got about 2/3 remaining value in your accumulated depreciation. And the reason we like looking at both the accumulated depreciation and the remaining value is if companies have very low net book values on their productive assets, that means they're going to have to start buying. That means they've been delaying purchases. And that's a big indication for a financial analyst. Okay, the next, so let's look at everything here. So your total assets, let's see what we get for total assets here is, I know what I've got to do here. It's just something I need to do. Let's change cash to 4,300. I want these things to balance, and I made a change when developing this example. Balance, okay. So your total current asset, and let's make accounts receivable 8,500. I want to change accounts receivable to 8,500. I just corrected these numbers. I redid this an example. It was for a service, and I'm just doing it for the first time. Okay, so your current assets are 14,600. I'm going to go ahead and bold those. Okay, and your total assets are going to be, I'm going to make this net book value bold too. In a sense, that's your total non-current assets. Okay, and we'll underline this because it's a subtotal. Okay, so your total assets are 14,600 plus 22,400, 37,000. So your total assets are 37,000, and that's what, in the end, my total liabilities and shareholders' equity should be equal to. Okay, finally, I'm going to get down to the second half of the balance sheet, which is liabilities plus SE, I'll just acronym it, plus shareholders' equity. Okay, so this is huge. Okay, so we're going to do liabilities first. We have liabilities. Okay, so put a period there. Nope, let's take it out. Okay, so your liabilities are subtotal here, and I'm actually going to put in current liabilities, and I think in this example we don't have any non-current liabilities. Current liabilities. So your current liabilities, if I'm looking at this right, should be equal to your total liabilities because there's no non-current here. Okay, so let's put in the 3 current liabilities here. We have, or there's only 2. Accounts payable. Go way up here. So we get accounts payable, that one. And then we'll do, I think it's salaries payable. Okay, and put them right here. Not that big a deal, but actually I could probably put it over here. So your accounts payable is equal to 10,200. Your salaries payable is equal to, I believe, 3,000 somewhere here. There it is. 3,000. Okay, so I'm just going to subtotal these. Bring these 2 down. Misaligned them. Bring these 2 down. And then what we're going to do is we're going to say, I'm just going to call it total current liabilities. And in this case, your total current liabilities are equal to your total liabilities. So I'm not going to, you don't need a subtotal. You need a subtotal. Your total current liabilities are equal to 13,200. It's kind of an interesting number. When you think about this, I'm thinking ahead to financial statement analysis. When you think about this, one thing you should always ask yourself is, do you have enough cash to pay for your total current liabilities? So you owe in the next year 13,200. What is their cash balance? Only 4,300. So what that says is presently they don't have enough cash, so they better collect some of those accounts receivable, convert them to cash, so that they're able to pay off that 13,200 current liabilities. Okay, then finally we're going to do shareholders equity. I'm just going to use the acronym shareholders equity. Okay, I want to get this example over with. Okay, and there's 2, as I said before, there's 2 categories of shareholders equity. The first one is paid in capital. Some people call it contributed capital. Paid in. And there's only, and paid in capital consists of 2 things: common stock and additional paid in capital. I just have a common stock account here, so we'll just do that. And that might be real. There's circumstances where some companies don't even have a par value, so you wouldn't have any additional paid in capital. Anyway, so common stock, that's my total paid in capital, and common stock is equal to, let's see what we got here. Common stock is equal, should be 8,900 somewhere. 8,900, that's good. Okay, and the second category of shareholders equity is retained earnings. Paid in capital is money you get, like I said before, when you issue stock. Retained earnings comes from earnings that the company retains, which officially, theoretically belong to the shareholders. Now, your ending retained, what am I saying? We go here to the statement of retained earnings, and this ending number, statement of retained earnings, is where I'm going to, oops, what did I do here? Okay, anyway, I got ahead of myself. Retain, I'm just going to say, is equal to retained earnings, your ending retained earnings, which is that title right there, and it's equal to, I think it's 14 something, 13.2, 14.9 is what it's equal to. Okay, so your total shareholder, so you got 8,900 that you got from issuing stock, and you've accumulated 14,900 retained earnings. I'm going to put this in bold to emphasize that paid in capital and retained earnings are 2 different categories of shareholders' equity. I'm going to say total shareholders' equity here. Your total shareholders' equity is equal to the 8,900 plus the 14,900. I'm going to subtotal this, and let's see what we get for our total shareholders' equity and liability. Total or liabilities plus shareholders' equity. That total is equal to 13,200 plus the 23,800, 37,000. That looks pretty good to me. I'm going to go ahead and double underline this because it's your final. I'm going to put it in bold here too. Now, of course, what we've been saying is the balance sheet must balance. In this case, it does balance. Your total assets, 37,000, are equal to your total liabilities for shareholders' equity, which also total 37,000. I'm going to go ahead just to make myself feel good. I'm going to put that in a double underline. Okay, so your balance sheet balanced 37,000 each side, so we look good. But think of articulation here. I just want to repeat. What happens is you basically start with net income. Your net income was your income statement, which was the bottom line of your income statement, which was you had a net income. I'm going to put this in bold and double underline it. Okay, your net income was 8,500. Okay, then you go down to your statement of retained earnings. Your net income comes from the 8,500. So I'm not going to put arrows here. I almost feel like putting arrows there. But just to emphasize, that net income comes from your net income. The first line of the statement of retained earnings comes from the beginning retained earnings from your beginning balance sheet, which I took the liberty to put shortcuts on. So there's your beginning retained earnings comes from your beginning balance sheet, add net income. That gives you a subtotal. Your dividends are just it's just how much dividends you decide to pay. That's your choice. In this example, I assume that we paid 7,600 dividends. I think I changed that. Anyway, our ending retained earnings are 14,900. And keep in mind, this is the last thing I'll say, is the ending retained earnings, after you take beginning retained earnings of 14,000 from your beginning balance sheet, your net income from your income statement, which is right there, those two numbers are equal. Your dividends will always be given, that's just dividend policy. Your ending retained earnings always get plugged into your ending balance sheet of 14,900. And anyway, so I've been talking for a long time here, but I believe, even with all the little mistakes I made, I made little mistakes to change the example. This should help you because I'm going to send you the worksheet and post it on Brightspace, but I'll send you the worksheet. So together with the class, this should give you a hint. This should help you, this example, regarding some of the homework problems. I think there's one or two homework problems that would say preparing financial statements with raw data. This example is very close to those homework examples. And I wanted to give you this now because I noticed that the chapter covers, making financial statements with raw data, and all the raw data is here. And just to make myself feel good, I'm going to finish by marking all these X's. I did, in fact, consider all these accounts somewhere or other. Okay, so anyway, hope everybody has a good night. I'll be posting it tonight. It's 10:13 on Tuesday the 28th, and I'll post it on YouTube tonight, and I'll try to get you an email out tonight too. Anyway, after going for a walk. Anyway, I hope everybody stays well. Thanks for listening to this. It's an hour long, but man, it was worth it. This is one of the most important parts of accounting, is making financial statements, and then what we do next is going to be analyzing financial statements, starting with Pfizer. Okay, so let's just put here